Good morning, hunters, and welcome back to the Daily Hunt for Multibaggers on this Thursday, May 7th, 2026. We've got a busy show today, looking at the data collected yesterday, May 6th.
You know, it was quite a day for online discussions. Our AI flagged a significant amount of social media chatter across many different stocks.
Absolutely, Brooke. There was a lot of excitement and strong conviction in certain corners, particularly around the AI and tech sectors, indicating some promising sentiment.
While the enthusiasm was certainly palpable for many, a closer look at the underlying metrics reveals a healthy dose of risk in some of these high flyers. It's definitely a mixed bag of opportunities and cautionary tales out there.
Kicking things off with a familiar giant, Meta Platforms Inc., Meta. Social media discussions are using Meta as a benchmark for growth, especially its Instagram segment. Users highlight its status as a key hyperscaler in the AI supercycle, and its forward PE looks quite attractive compared to some of its big tech peers. We've seen it rated as a buy frequently in the past, and it's looking strong again today.
Well, Ethan, while Meta's certainly making massive AI investments, we're talking up to $145 billion in infrastructure and boasts impressive revenue growth at 33% and a net profit margin of almost 33%. We can't ignore the legal challenges. There's a social media addiction verdict and a new AI copyright lawsuit. And let's remember, some recent earnings did get a significant tax boost, so that net profit margin needs careful consideration to see if it's truly sustainable without that tailwind.
Still, the PEG ratio is below 1, suggesting it might be undervalued relative to its growth, and analysts love it. For Meta, given its strong fundamentals and AI pivot, the AI-generated insights lean towards a buy.
Next up, Reddit Inc., RDDT. Now, user sentiment is overwhelmingly bullish, with talks of $200 and even $500 price targets, citing 69% revenue growth and strong profit margins. But let's pump the brakes a bit even. That PE ratio is sitting at 47.5, which is a hefty premium for its growth, and we've seen an analyst downgrade recently. It's also been a stay away or speculative gamble more often than not in our past ratings.
But Brooke, the community is buzzing about it being a cash-printing machine with a fortress balance sheet. They're pointing to huge catalysts like S&P inclusion and major AI data licensing deals with Google and OpenAI. Insiders are net buyers too, which always shows confidence. Those future developments could absolutely improve those KPIs.
Potential, yes, but at that valuation, it's priced for perfection. For now, we're classifying RDDT as a stay away. The risks of overvaluation and unproven catalysts are too high for a general investment. Let's shift gears to TMC, the Metals Company, Inc., TMC. This one has users incredibly bullish, talking about impending NOAA permits for deep-sea mining and its strategic importance for U.S. critical minerals. They're comparing its net present value to its current price, saying it's massively undervalued.
Ethan, the enthusiasm for future permits is high, but the reality is TMC currently has an EPS of negative 0.83 and zero net profit or operating margin. That's a company not making money. Its price to book is a negative 77, indicating negative shareholder equity. While insiders are buying, this is a highly speculative pre-revenue company with extreme volatility. It's been a stay away since October 2025 for good reason.
Right, well, the potential is undeniable, but Brooke's right on the current financials. So for TMC, it's a stay away. Moving on, Western Digital Corporation, WDC. There's a strong bullish buzz for WDC as a sympathy play, benefiting from the AI storage demand, much like Micron. People are even dreaming of SanDisk, a part of WDC, reaching Micron's market cap. News shows strong AI storage demand and even a dividend hike. I hear the hype, Ethan, but let's look at the numbers. WDC is trading at its 52-week high, which is often a risky entry point. Its price to book is an eye-watering 23, and the debt-to-equity ratio is a very high 17.8. Plus, insiders have been net selling over 147,000 shares in the last 6 months, despite the positive market sentiment. Our last rating was stay away. Given the stretched valuation and insider selling at these highs, WDC will remain a stay away for us today. Now, Rocket Lab Corporation, RKLB. User sentiment is a real roller coaster here, Ethan. Some are extremely bullish about a duopoly with SpaceX and the Neutron rocket, but many others are just down on the stock. They talk about post-earnings fades and a constant cash burn. Yeah, the community's split, but the Neutron rocket could be a game changer, capturing significant market share. People see space as the future, and RKLB is right in the thick of it. There's real optimism for the long-term vision.
But the financials are screaming caution. RKLB is deeply unprofitable with negative net profit and operating margins. Its debt to equity is 15.4, and the price to book is 26.7. The most alarming KPI is the insider selling. Over 3.6 million shares sold in the last 6 months, representing 71% of total insider holdings. That's a huge red flag. This has been a stay away or speculative gamble consistently. With those kind of metrics, RKLB is a clear stay away. Back to the blue chips, Microsoft Corporation, MSFT. Users implicitly praise its software monopoly business model, acknowledging its profitability in AI and cloud. Q3 revenues jumped 18% on AI and cloud. It's a consistently strong performer. Microsoft's revenue growth at 18% and net profit margin near 40% are definitely impressive, showing strong operational efficiency. And it's trading below its 52-week high, which is positive. However, the debt to equity is quite high at over 30. While it's a powerhouse, a $25 price target trim, even with better than expected results, reminds us to stay vigilant. Still, its fundamentals are rock solid, and it's a pivotal player in the AI landscape. For Microsoft, we classify it as a buy. All right, let's talk about Qualcomm Incorporation, QCOM. There's a growing buzz about Qualcomm being a key player in physical AI and robotics, essentially the brains of the next big tech theme. Users are calling it undervalued at 17 times forward earnings compared to peers, and are excited about its automotive, IoT, and upcoming data center growth. Ethan, a PEG ratio of 0.72 is certainly attractive, suggesting it might be undervalued relative to its growth. And those insiders are buying. Nearly 17% net shares purchased over 6 months is a strong vote of confidence. However, recent revenue growth has been slightly negative, though the analysis explains this as a temporary semiconductor hangover. The June 24th Investor Day will be critical for validating the data center opportunity.
With that kind of insider belief and strategic positioning, QCOM is a buy for us. It could be a future leader. Now for Oklo Inc., OKLO. This small modular reactor company is sparking a lot of bullish sentiment. Recent NRC approval for its Aurora powerhouse design is huge news, positioning it to power AI data centers, and there's even a $120 price target out there. Plus, insider buying is off the charts, nearly 95% net shares purchased.
Ethan, that insider buying is definitely compelling. But let's be realistic. Oklo currently has an EPS of minus 0.72 and absolutely no net profit or operating margin. It's an early-stage company with a high price-to-book of 8.6, meaning investors are paying a huge premium for future potential that isn't yet realized. While the NRC approval is a step forward, it's still a long road to profitability in full-scale operations.
That potential, combined with the insider confidence, makes it too interesting to ignore. We'll mark Oklo as a cautious buy.
Let's look at Robinhood Markets, Inc., Hood. User sentiment is really divided. Some are bullish, mocking those who sold at a loss and seeing it as an attractive entry point. Others are expressing major market pessimism and specific negative sentiment towards fintech.
Well, the company does have 15% revenue growth and over 41% net profit margin. And they just got approval to launch brokerage services in Singapore. That's future growth, you know?
Future potential? Sure. But a PE of 38.3 is quite high for a company that's lagged Q1 earnings due to a crypto slump and is facing increasing competition. The debt-to-equity ratio is an alarming 140, indicating massive leverage. Also, a beta of 2.29 means extreme volatility. It's been a stay away often, and the insider selling we noted in the news doesn't help.
Okay, the risk factors are significant there. Hood is a stay away.
And finally, Nebulous Group NV, NBIS. The user sentiment is consistently bullish, fueled by explosive past gains, massive AI infrastructure momentum, and a big acquisition. But Ethan, the KPIs tell a vastly different story.
I know, the community's seeing massive price appreciation, hundreds of %, and talking about huge AI startup takeovers. People are kicking themselves for selling too early.
They might be, but the PE ratio is an astronomical 4.877. This means its current price is almost completely disconnected from its meager current earnings per share of 0.04. It also has negative operating margins and an incredibly high debt-to-equity ratio of 108. Plus, insiders have been selling nearly $1 million worth of shares. Despite all the hype, the fundamentals are incredibly stretched.
Those are some scary numbers, even for a high-growth AI play. NBIS is a definite stay away for us today. All right, let's wrap up today's hunt with a summary of our AI-generated insights. Investigate as buy, Meta Platforms Inc., META, Qualcomm Incorporated, QOAC, Microsoft Corporation, MSFT. Investigate as cautious buy, Oklo Inc., OKLO. Investigate as speculative gamble, Nebulous Group NV, NVIS.
And that's all for today's Daily Hunt. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for joining us, hunters. We'll be back tomorrow with more insights and market commentary. Happy hunting!